So, if you're already using dollar cost averaging, you're honestly ahead of the game. It's disciplined, it's consistent, but what if it could be, smarter? Today, we're going to look at how to level up that investment strategy beyond just the basics.
And that really starts with a simple question. We all set up these automatic investments to take the emotion out of it, which is great. But in doing that, are we also ignoring some really valuable information the market is practically shouting at us? Let's find out.
All right, let's dive right in. First, we've got to look at the strategies so many of us know and love, the classic dollar cost averaging, or DCA, and the core problem it kind of presents. Now, the idea itself is simple and honestly pretty powerful. You invest a fixed amount of cash, let's say $100, every single month on the dot. This whole approach smooths out your purchase price over time and, maybe more importantly, builds a fantastic habit of consistent investing. But here's the catch, the big dilemma. That same disciplined, almost blind approach means you're investing your $100 when the market is plummeting, when it looks like a massive sale. And you're investing that exact same $100 when prices are soaring at an all-time high. Kind of feels like we could be a little more strategic about it, right? And that right there is where Smart DCA comes into the picture. You should think of it less as a replacement and more like an evolution, a way to add a layer of market awareness to the discipline you've already built. So here's the whole idea in a nutshell. We're not trying to time the market perfectly. Let's be real. That's a fool's game. The goal is to just dynamically adjust our regular investment based on whether the market looks cheap or expensive. We buy more when things are on sale and a little less when things get pricey. Super simple. Okay, so how in the world do we know if the market is cheap or expensive? Well, we use this simple but really powerful tool called a linear regression channel. And hey, don't let the name scare you. It's basically just a tool that calculates the historical average price trend of whatever you're looking at. And this chart really just simplifies the whole concept beautifully. You see that dotted line running through the middle of the channel? Just think of that as the fair or normal price based on all its history. So if the actual price is below that line, it's arguably on sale. If it's way above it, well, that's getting expensive. This right here breaks down the entire strategy. When the price dips down low, below that middle line, we boost our monthly investment. When it climbs up high, above the line, we just dial it back a bit. It's a simple, rules-based system for buying low and, well, for buying a lot less when it's high. Okay, theory is great, but let's get practical. How can you actually set this up for yourself? It's surprisingly easy, and you can do it completely for free. Let's build your toolkit. Here are the 4 simple steps. First, just head over to tradingview.com. You don't even need a paid account for this. Then pull up the chart for whatever you're investing in, maybe the S&P 500. Click that indicators button at the top, and in the search bar, just type linear regression channel. And this is exactly what you'll see. Over on the left, you've got the search window. You just click on linear regression channel, and boom, it's on your chart. On the right, you can see the settings panel. Honestly, for now, the default settings are a great place to start, so you don't even need to mess with them. All right, now for the exciting part. Let's see how this all comes together into a practical strategy. We have the tool. Now let's apply it to some real-world market events. This is where it gets really interesting. So here's the simple math that makes the whole thing work. First, you figure out how far the current price is from that middle normal line as a percentage. Then you just multiply that percentage by 3. That final number, that tells you exactly how to adjust your monthly investment. Let's stress test this with a moment we all remember vividly. That sharp, terrifying market crash in early 2020. I mean, it was pure panic for a lot of people. But what did our calm, cool-headed strategy tell us to do? At its absolute lowest point, the S&P 500 had fallen a staggering 35% below its normal price line. A classic DCA would have been completely blind to this, just putting in the same old amount. But Smart DCA? Oh, it saw a massive neon sign flashing opportunity. So we run the numbers, that 35% drop, we multiply it by 3, and we get 105. That means we should increase our investment by 105%. Now, to be smart about it and make sure we have cash for the next month, we capped that increase at 100%. So you'd literally double your investment that month. You can see it right there on the chart. That dramatic dip was the clear signal. While so many people were selling out of fear, this strategy would have systematically guided you to buy aggressively when assets were at their biggest discount in years. That is a powerful, powerful difference.
Okay, but a good strategy has to work both ways, right? It can't just be about buying the dips. What happens when the market gets overheated and prices start to feel a little, bubbly? So let's look at a different moment in time where the price had climbed 18% above that middle regression line. The market was hot, and the asset was now officially considered expensive compared to its own history.
We use the exact same formula. 18% times 3 equals 54. So the strategy tells you to reduce your regular investment by 54%. If you were putting in $100, you'd now invest about $46, automatically protecting your capital a bit when the market is getting frothy.
Now, this all sounds pretty great, but listen, no strategy is perfect. Before you run off to try this, we need to have a serious chat about the limitations and the reality of using a tool like this. It is absolutely essential to understand that this is just one tool in your financial toolbox. It's incredibly useful, for sure, but it is not a crystal ball. So let's be super clear about the risks involved. There are three really crucial things to remember. First, this entire model is based on historical data. And as we all know, past performance is no guarantee of future results. Second, unlike a set it and forget it DCA, this requires you to check in, do the simple math, and actually adjust your investment. It takes a little more discipline. And finally, and this is the most important one, this is a strategy for when to buy, not what to buy. It does not replace the fundamental need for proper risk management, like having a diversified portfolio. Look, Smart DCA can be a really powerful way to optimize your investments and potentially boost your long-term returns. But it's just one part of a much bigger picture. It pushes us to think more actively about our strategy. So the real question is, how will you take this kind of dynamic thinking and integrate it into your own financial plan?